The previous video established what index funds and ETFs are and why passive investing outperforms active management over long time horizons for most investors. This video addresses how to actually invest over time, the behavioral and strategic principles that determine whether someone who understands the basics of investing actually builds wealth versus someone who understands the same basics but makes decisions that undermine their results. The mechanics of buying a low-cost index fund are simple. The harder part is the behavior required to stay invested through market cycles, make consistent contributions, and avoid the common mistakes that erode returns over time. The single most important principle in long-term investing is time in the market. This phrase is a compressed way of saying that the duration of your investment is the primary driver of your long-term outcome, more than your entry timing, more than your specific fund selection within the universe of reasonable options, and more than any tactical adjustment you make along the way. The mathematical basis for this principle is compound growth, which was introduced in the previous video. Returns compound on previous returns, and the longer the process runs uninterrupted, the more powerful the outcome. Removing money from a market, whether through panic selling during a downturn or simply delaying the start of investing, interrupts compounding and reduces the time available for it to operate. Every year of delay has a real, quantifiable cost to the final outcome. The corollary to time in the market is the danger of attempting to time the market, meaning trying to sell before a decline and buy back in before a recovery. The appeal of market timing is obvious. If you could exit the market before major downturns and re-enter at the bottom, you would dramatically outperform a buy-and-hold investor. The problem is that no one can do this reliably. The evidence that professional investors consistently time the market successfully is essentially non-existent. The challenge is not just predicting when the market will decline, which is already nearly impossible. It is also predicting when the recovery will begin, which is equally unpredictable, and acting on both predictions correctly before the market has already moved. The cost of being out of the market during the best days is severe and illustrates why failed market timing attempts are so damaging. Research on the S&P 500 consistently shows that a significant portion of the market's long-term return is concentrated in a small number of trading days. Missing the 10 best trading days over a 20-year period roughly halves the ending portfolio value compared to staying fully invested throughout. Those best days are unpredictable in advance and often occur in the aftermath of severe market declines, precisely when fear is highest and the temptation to stay out of the market is strongest. An investor who sold during a decline, intending to buy back in at the bottom, frequently misses the sharp initial recovery because they're waiting for confirmation that the worst is over, which only arrives after the best days have already passed. Dollar cost averaging is the investment strategy most compatible with human psychology and with the practical reality that most people invest from ongoing income rather than from a lump sum. Dollar cost averaging means investing a fixed dollar amount on a regular schedule, typically monthly or with each paycheck, regardless of current market conditions. When markets are up, your fixed contribution buys fewer shares. When markets are down, the same contribution buys more shares. Over time, this produces an average cost per share that is lower than the average price over the same period, because more shares are purchased at lower prices than at higher ones. More importantly, it removes the psychological burden of deciding when to invest. The decision is made once at the level of the automatic contribution and then executed automatically without ongoing deliberation. The behavioral dimension of long-term investing is as important as the financial mechanics and receives far less attention in most financial education. The gap between the returns that investment markets produce and the returns that individual investors actually capture is well documented. Research by the firm Dalbar, which analyzes investor behavior and mutual fund cash flows, consistently finds that the average equity fund investor significantly underperforms the funds they hold, often by several percentage points annually. The primary reason is behavioral. Investors tend to buy after markets have already risen, attracted by recent strong performance, and to sell after markets have declined, driven by fear of further losses. This pattern of buying high and selling low is the opposite of what rational investing requires, and it is produced by emotional responses to market volatility that are entirely natural but financially destructive when acted upon. Understanding market cycles is the cognitive tool that makes it easier to stay invested during downturns. Markets move in cycles of expansion and contraction, and those cycles are driven by the collective psychology of millions of investors as much as by underlying economic fundamentals. Bull markets, periods of sustained price increases, generate optimism and eventually complacency. Bear markets, defined as declines of 20% or more from a recent high, generate fear and pessimism. The emotional experience of a bear market, watching a portfolio lose a third of its value with no clear end in sight, is genuinely uncomfortable even for experienced investors. The historical perspective that matters in those moments is that every bear market in United States history has eventually been followed by a recovery that exceeded the previous peak. The investor who stayed invested through the downturn and recovery captured the full cycle. The investor who sold during the downturn locked in the losses and then faced the additional challenge of deciding when to re-enter. Maintaining an investment policy statement, even an informal one, is a practical tool for managing behavior during volatile markets. An investment policy statement is a written description of your investment goals, your time horizon, your target asset allocation, and the conditions under which you will rebalance. Writing it down when you are calm and rational before market disruption creates a reference point to return to when emotions are running high. When a market decline triggers the impulse to sell, reviewing a document you wrote to your future self, explaining why short-term volatility is expected and acceptable within a long-term strategy is more effective than trying to reason through the decision from scratch in the moment. Rebalancing, introduced in the previous video, is both a risk management practice and a behavioral discipline. As stocks outperform bonds over extended periods, a portfolio initially allocated 60% stocks and 40% bonds will drift toward a higher stock allocation. Rebalancing back to the target means selling some stocks and buying more bonds, which systematically enforces a sell high, buy low behavior. Annual or semi-annual rebalancing is sufficient for most investors. Rebalancing, too, frequently generates unnecessary transaction costs and tax consequences in taxable accounts. The purpose is to maintain the intended risk profile of the portfolio, not to optimize every incremental allocation shift. Tax-efficient investing is a component of long-term strategy that significantly affects the net return on your investments. In taxable brokerage accounts, investment returns are subject to capital gains taxes when realized. Long-term capital gains on assets held for more than 1 year are taxed at rates of 0, 15, or 20% depending on your income level, which is substantially lower than ordinary income tax rates. Short-term capital gains on assets held for 1 year or less are taxed at ordinary income rates. The implication is that holding investments for at least 1 year before selling produces a significantly lower tax rate on the gains, which is one more reason that long-term buy-and-hold investing is more tax-efficient than frequent trading. Tax loss harvesting is a technique available in taxable accounts that involves selling investments that have declined in value to realize a capital loss, which can be used to offset capital gains realized elsewhere in the portfolio, reducing the overall tax bill for the year. The sold investment is replaced with a similar but not identical investment to maintain the portfolio's market exposure while capturing the tax benefit. If capital losses exceed capital gains in a given year, up to $3,000 of the excess can be deducted against ordinary income, with any remaining losses carried forward to future years. Tax loss harvesting does not change the fundamental character of the investments or the long-term strategy. It simply optimizes the tax treatment of returns within a strategy that is already sound. Asset location is a related concept that refers to which types of investments are held in which types of accounts. Tax-advantaged accounts like traditional IRAs and 401k plans shelter investment returns from current taxation, which makes them the ideal location for assets that generate the most taxable income or the highest turnover. Taxable brokerage accounts are better suited for assets that generate lower taxable income and that can be held efficiently for long periods. placing high-yield bonds and REITs, which generate substantial taxable dividend income, in tax-advantage accounts while holding total market index funds, which generate minimal taxable distributions in taxable accounts, is an example of asset location optimization. For investors with multiple account types, thoughtful asset location can meaningfully improve after-tax returns without changing the overall investment strategy. The most effective long-term investment strategy for most people is not complex. It is investing consistently from income in a broadly diversified portfolio of low-cost index funds, in tax-advantaged accounts whenever possible, without interrupting the process in response to market volatility or economic news. The value of this approach comes entirely from its consistent execution over time. Every deviation from it, whether through market timing, chasing recent performance, or reacting to headlines, introduces the risk of reducing returns without a corresponding benefit. The discipline required is not the discipline of doing more. It is the discipline of doing less, of staying invested, and continuing to contribute when the financial news is frightening and the temptation to act is highest. That discipline, applied consistently over decades, is what separates investors who build meaningful wealth from those who understand the concepts but fail to capture the returns that the market makes available to them.